Good afternoon to the workers, good morning to the unemployed. My name is Bendo Buck, and in this video, we'll be diving into an introduction to cryptocurrencies, more specifically, a Bitcoin story, as Bitcoin was the first cryptocurrency to be ever created. So, before we begin, I have a few disclaimers to make. I am stupid. This is not for financial advice, as the crypto market could plummet tomorrow. I don't know. This is only for educational purposes to make you understand better the world of cryptocurrencies rather than investing in cryptocurrency. So this video is for financial literacy and for long-term crypto adoption. I am here only to make friends and share my enthusiasm for cryptocurrencies with you guys. So the subjects that we'll be touching today will be a few descriptions towards the crypto world. What are NFTs, the different crypto asset classes that exist, and the three pillars of crypto. When I'm talking about three pillars of crypto, it's more like why you should get into cryptocurrency, or what are the incentives for you as a users to get into cryptocurrencies. And finally, we'll touch on a few barriers to entry as why there's not that much people into crypto. So let's begin. What are cryptocurrencies and what makes them so great? So a cryptocurrency is typically decentralized digital money designed to be used over the internet. As you can see, it is a fusion of crypto and currency, or secret money. Cryptocurrencies. Well, if I can maybe help you wrap your head around just the concept of this secret money, I can explain to you what happened before we had such system. So before that, we had digital money, but that was centralized. It was centralized by the bank, as the bank was a central point that would take every order, every transaction, and verify them and make sure it is by the norms. Well, this is where Bitcoin comes into play. So I just wanted to talk about what Trudeau has been doing. Trudeau vows to freeze anti-mandate protester banks account. So this is one of the power that the government has, the power to suspend your account, the power to block every transaction that you can make. So with a decentralized system such as Bitcoin, Phantom, Ethereum, say it, um, there's no third party, or there's no um, entity that can block someone or that has more power than the other. Everyone has the same power when making transactions, and no one can stop the blockchain from operating. So we say that Bitcoin solved double spending, as it is impossible to send the same Bitcoin to two different wallets. You can send the same email to two different addresses, and that wouldn't make such a big deal as it is not money. But when it comes to money, it is really important that you're only able to send $1 to one person. So I've just listed a lot of cryptocurrencies that tried what Bitcoin does, but ultimately failed. Like all of these eGold, eCash, DigiGold, CyberGold, Intercoin, even PayPal wanted to be cryptid at the beginning, but that's not a thing they did. So cryptocurrency, I'll try to explain why we say it is cryptid and why it's such a big thing. We say that it is cryptid because every transaction is um, hashed onto the blockchain. So what is a blockchain technology and why it might be a catalyst for change for the financial sector? So blockchain technology is the technology to be able to store data forever. We say that the blockchain is immutable, as you can only add transactions and you cannot remove or alter previous transactions. Every transaction made onto the blockchain will have to be analyzed by the nodes, make sure they're being verified before they're added onto the blockchain. Once all of those transactions have been verified, they will be placed into a pool and just they will wait until they're being added onto the blockchain. So every block contains a lot of transactions. Every block contains the version of the system, the previous block hash, the Merkle root hash, the difficulty target, and a nonce. I don't want to make this video too technical, but for now, just know that the nodes follow a set of rules when creating new blocks. They are rewarded with Bitcoin, with their native currency, as every block added to the chain will reap rewards for those that mined it. And when I'm using um, the Bitcoin ecosystem for myself, what I can do is every time I send some Bitcoin, I'll be paying some fees. Well, those fees goes to the miner as well. So the miner, while their task is to verify every transaction, once those transactions are being added to the blockchain, they will reap the rewards from the fees and from the mining as well. Cryptocurrency. We have to talk about what money is and really um, how can it affect the world of cryptocurrencies. Well, for now, as regular money, money serves as a medium of exchange, a store of value, and as a unit of account. We call this money, or Canadian money is a fiat currency, as it is you're obligated to accept Canadian money when you're being offered Canadian money. When I work as a restaurant and people ask to pay with US dollars, I am not legally um, forced to accept their money. I can tell them no, I would like some Canadian money as I am in Canada. I am not a bitch waiter, so I take their money and I do the things, but fiat money just means yes money. Fiat means yes in Latin, and you're obligated to accept it. We say that money is a medium of exchange as it is really unlikely to find a double coincidence in our society. Let's say I want a certain good and you might have it, but do I have what you want? And this is really complicates everything in terms of exchange, as money you can just go purchase what you'd like and you already traded that good for money. We also say that currencies are a store of value, as if you have $100 million worth of bananas, well, in the next week, I doubt that the value will remain when all of those bananas goes rotten. This is why I put gold next to it, as gold does not change with time. This is why most people invest in gold and think it will remain as a stable value, as there's not a lot of volatility around gold, as we know it will not change. And finally, we say that fiat currencies are a unit of account. It is a unit of account because when I go to work, I don't say I am being paid one steak per hour. I say I am being paid $10 per hour, or how much money I have in my account. A lot, but I use a unit of account. I don't use random numbers or random items to say it. So now cryptocurrencies as well can serve as a medium of exchange, as a store of value, as a unit of account, and as voting power. So this is like a differentiation that we can make between real money that we have, physical money, and those cryptocurrencies. As no one in the real world will ask you to prove that you're using Canadian money to vote, and how much Canadian money you have does not impact the vote that we have. But if I am on Phantom and we have a voting on a proposal, well, the amount of Phantom that I own will be really important. As once I give my vote in, the more I use, or the more this a proposal will affect me, the more voting power I should have. If every day I'm using Phantom, well, I should be having more Phantom than someone else and have more voting power than them. So to recap, what are cryptocurrencies? So by now you should understand that cryptocurrencies are a secure form of digital money online. All of those transactions are being stored onto the ledger, and there's a trustless system. A cryptocurrency is typically decentralized money, digi- uh, digital money designed to be used over the internet. Let's talk about blockchain utility. such as NFTs. You might have heard this term thrown around, what are NFTs? But the real question is, what is the difference between a fungible token and a non-fungible token? I think you might be able to better understand if I can explain what a fungible token is. So a fungible token or asset are divisible and non-unique. So you can understand that NFTs are non-divisible and unique. For instance, fiat currencies like the dollar are fungible. A $1 bill in Montreal will have the same value as a $1 bill in Toronto. A fungible token can also be a cryptocurrency like Bitcoin. One Bitcoin is worth one Bitcoin no matter where it is issued. So this is different for NFTs as non-fungible tokens. Non-fungible tokens are unique assets with a proof of ownership. So why would I want to prove my ownership to something onto the blockchain? Well, before the blockchain, we would just be able to prove ownership by the government or being able to sign some papers. But with the blockchain, it is really easier to prove your ownership as it is just being recorded onto the blockchain. So you can prove your ownership for art, which most NFTs are. They're just like a JPEG that are linked with some ownership. There's some collectibles such as all of the VV collectibles. I'm not really into that, but there's also some sports moments. We can see some drop shot, hot shot that were made. There's music NFTs and there's some gaming NFTs. Let's say I'm playing League of Legends, even if I ate the game. Well, I have some skins or I have some assets inside of the game. If I can have a marketplace to be able to sell those skins or sell those runes or assets that I have, this becomes much more interesting as all of the money that are being in circulation does not go to the producer of the game, such as Riot Games. It would go to the marketplace. We have domain names for ownership, metaverse land, real estate, fashion, and finally financial NFTs. Personally, I really like some financial NFTs as I think there's a real usage behind them. Just a JPEG, I mean, I think there's a bubble in terms of the collectibles and the arts as well in the gaming industry. But that's my call. I mean, if you have some hard collectibles, you don't need to sell them because I told you so. So this is an example of a financial NFTs that we have. Financial NFTs can be ownership of, let's say, trading fees or ownership of voting power, which is really interesting. For next, I'd like to talk about the classes of crypto assets. This is really important as the store of value is fundamentally different in its coding from a privacy coin or a layer one or any other coins. So store of value, the real thing that you want when using a store of value is to keep the value of your coins. When we say that, I don't know, I have like 20 Canadian dollar and we know that the inflation is going up, well, my value, my purchasing power is going down with time as there are being more and more Canadian dollar printed. For Bitcoin, we know that there is a maximum supply of 21 million Bitcoin. So we know that your purchasing power will be diluted with time, but not that much as it can be seen as an inflation edge. In second, we have smart contracts. Smart contracts are if then, this that. So it's basically just our smart contract to being able to process data or just to process execution. Being online in 2022, it's much more different than when Bitcoin was created in 2008. Right now, we're able to do some gamify, we're able to do some DeFi, we're able to do some applications, some cloud services. Well, all of these cloud services, if we would like for those applications to be decentralized, we need some smart contracts. So let's say for a smart contracts, let's say some insurance. I am a farmer, and if that day the temperature goes under 20 degrees, well, I know my crops will fail. Well, I have an insurance on that, and I'd like someone to pay me if the temperature goes sub 20 degrees. Well, so If the requirement is met, something will happen. This is what smart contracts are for. Well, let's say we're talking about real world data, such as the temperature. How can you know the temperature from the blockchain itself? You cannot. So you need a third party, such as oracles. We call them oracles, such as Chainlink, which is the biggest oracle out there, to put real world data inside of your blockchain. So the oracles would just be like, okay, well, today it's 20 degrees, and I'll upload that into the blockchain. Every smart contract that needs this information will go get it and will do their things afterwards. And number four, we have exchange tokens. Exchange tokens are heavily linked to the performance of the exchange itself. If Binance does well, well, BNB should go up. And if Crow has an amazing marketing team, usually we have more investment inside of Crow. More investment means more liquidity for Crow, which uh, ends up has a higher market cap for Crow. And number five, we have payment crypto. Personally, I'm not the biggest fan of payment crypto. I don't really like them, but it is mostly used by banks. Personally, I prefer some privacy coins as I am a really big defender of my own privacy. And if I would like to make a payment, I just use privacy coins. I'd rather just use privacy coins and no one has to know about it. Only the intended recipient will get the money, and I will know that I've done my part of the margin of our deal. So I don't have to use payment crypto as most of the time they're pseudo anonymous, such as Bitcoin, and I'd like my privacy. That's it. And in number seven, we have play to earn. I more like them. I more call them pay to earn, as you need to be investing a lot of money inside of them before you're able to make any money. So not that I don't use pay to earn, but I tend to stay away from them. And number eight, we have meme coins. Hate them or love them. Meme coins are a powerful asset that can see tremendous growth. But for the two meme coins that made it, thousands have died. So just be careful when investing in meme coins. Um, I'm presenting you all of these assets as if you're investing in a play to earn, you shouldn't be expecting the same returns or the same market cap as a store of value. Let's say you think your store of value will go down with time. Right now, Bitcoin is at 40,000 and you think it will go down to 35,000. So before it crashes, you have the idea to switch it to a stable coin. A stable coin is a coin that is pegged to the US dollar no matter what happens. As this is really important for you to keep your value and this facilitates exchange overall. Right now, I'd like to talk about the Bitcoin dominance. The Bitcoin dominance is a powerful indicator of how much the crypto market is heavily linked with Bitcoin. I see Bitcoin as an ETF of the whole crypto market, as the whole crypto space. As most of the time, it would oscillate between 40% to 50% of the whole market. Let's say the whole market is worth $2 trillion. Well, I know if there's a 50% Bitcoin dominance, that Bitcoin is worth around $1 trillion. So there are two ways to analyze this data. You can either think that 40 to 50% of all crypto users have their entire bag in Bitcoin, or you can think that the entire population that invests in crypto, their bag has between 40 to 50% of Bitcoin. Myself, I do not own some Bitcoin. I don't really like it, but um, it's something to keep in mind that the whole market is heavily linked with Bitcoin. As if Bitcoin goes down, well, you might have some selling pressure for your other assets that you'd like to sell and invest back in Bitcoin. Or if Bitcoin is doing really nice that day, maybe you would like to sell some Bitcoin and buy other assets and diversify your portfolio. So this is why we tend to say that the market is heavily correlated with Bitcoin, because the market really is Bitcoin. Half of the market is only Bitcoin. And now, why would you get inside of cryptocurrencies? These are the three pillars of crypto: money, applications, and ownership. Let's begin with money. Most people get inside of cryptocurrencies because they think they can make a lot of money, which is not wrong, but it's not promised as well. So you'd have three variables with every coins. I'm using CoinMarketCap. I'll link it below. I'll link everything I'm using, all the sources that I've used in the description below. If you guys would like to see it, don't hesitate. But the three variables for any coins would be their price, their market cap, and their circulating supply. These three variables really impact the future of of the currency that you're investing in. Just be aware that a higher price tag doesn't mean that there's less room for growth, or that a lower price tag under 1 cent really means a room for growth. It doesn't. So I'd like you to understand that the price of a cryptocurrency equals the market cap divided by the supply. The market cap would equal the price tag times the supply, and the supply would equal the market cap divided by the price. If one of your cryptocurrencies, let's say like Shiba Inu, has 300 trillion in supply, well, the whole market cap of Shiba would have to be 300 trillion for each Shiba Inu to be valued at $1, which is, to say the least, unlikely, as the whole crypto market right now is about valued at $2 trillion. So you need 100 hex from that. So you'd have 99% of Shiba dominance, which is something that I doubt. So let's say that in 2020, by the way, all of these numbers are fake. They're capped. They're just it was only for you to understand my example. So let's say that I buy 5 Bitcoin when the market cap is around 500 billion. And then in 2022, my 5 Bitcoins, I still own them, and the market cap has grown to 550 billion. Well, in this example, I'd make a 10% return, and this is how you can make money in cryptocurrencies. But I'd like just to remind you about the supply and the demand, as all coins really are linked to their supply and the demand. More like NFTs are really linked with their hype and their supply. In number two, we have applications or dApps. dApps for decentralized applications. Personally, I'm a really big fan of decentralized finance. I think this is the future. To be able to reconquer the power that the bank have stolen from us, we can finally give it back to the people. In second, I'd say we have gaming. Gaming right now, I mean, I'm a gamer. I always like to play some video games when I'm off of work. And if we could place a marketplace inside of those games, that'd be really something fun. But I can see this as a double-edged sword, as if there's always new users, well, everything should be valued more on your marketplace. But once your users tend to go away, everything will lose its value really, really fast, as the floor price would just continue to drop with someone being left with all of those assets of the game. In the third number, we have cloud, as you're able to store a lot of data onto the cloud, and there's a lot of businesses that offers cloud services. In number three, the third pillar of crypto, we have ownership. We've talked about ownership before, that NFTs really can put inside of the blockchain your ownership, and it will not go away. So let's finish with the barriers to entry in cryptocurrencies. The first risk I see everywhere in cryptocurrencies is that the learning curve is tough and unforgiving. It is really hard to understand cryptocurrencies to its root, and if you think you understand and you don't understand, well, you'll just lose money. And most of the time, there's no one to tell you if your understanding is right. Once you create those wallets, you'll be giving a seed phrase. It is your password, it is your private key you don't want to lose, or you don't want to share it with anyone. You must not share it with anyone. This is your right and your information and your money. It is really important. I cannot stress this enough to not lose it and not share it. Most wallet providers are non-custodial, such as MetaMask, Kelper, Exodus. This means that they do not own the data of their customer. So if you lose your account, you cannot go to MetaMask and be like, yo guys, can you help me out? Well, they'll tell you that they can't. They don't have the data inside of them, which is something we're not familiar with when we're talking about and thinking about the Facebook of this world, the Google of this world. We're we're so used that those big companies always store a data. That is something to keep in mind, that if you lose uh, your seed phrase, the company that has given you or created your wallet will not be able to help you. So it's just really important to always have a backup and a backup of your backup. So a third risk inside of cryptocurrencies, I'd say it's your funds themselves, your money. You can make big wins inside of cryptocurrencies, but you can also make huge losses, and really that will affect you for your financial lives. Just be mindful of your risk management. If a coin is out of the top 100, yes, it has more growth potential, but it has also more risk to just go to zero. There's a lot of pump and dump, farm and dump, pull rug, fake NFTs, phishing accounts. There's a lot of ways you can lose your account, you can lose your funds, you can lose everything that you have. So what's next? Well, honestly, guys, I don't really know. You should be telling me. But the first thing I really want you to do, it would be to like and subscribe to this video, as I'd be able to reach new viewers as yourself. I'd be able to reach new degenerate and make more friends. We could make a new video on Bitcoin in-depth analysis to explain to you how it works behind the scenes, how the blockchain works. We can make an introduction to DeFi or decentralized finance, such as for you to use your coins now that you understand what they are. We could also talk about any topics that I've learned at school, such as marketing, financial understanding, the psychology of money, how to be a great salesman. Really, there's a lot of opportunity for us to explore. If you'd like, please just leave me your feedback in the description, and for sure I'll read them and answer to you. So, to recap the whole video, what are cryptocurrencies? Well, cryptocurrencies are a form of digital money that is being used over the internet. These cryptocurrencies are so-called crypto because they're cryptid. Cryptid as they are being verified and approved by all the nodes before put onto the blockchain. We can only add new transactions to the blockchains and not remove them or alter previous transactions. This makes for a secure system. For sure, it is possible to make large sums of money in cryptocurrencies, but this effect can go both ways. You can lose a lot of money as well into cryptocurrencies. But just remember that the price tag of a cryptocurrency um, doesn't tell you the future of your cryptocurrency. It doesn't matter because of the price tag is really low that the cryptocurrency will go up. Or if the cryptocurrency has a large price tag, it doesn't mean it will not go up. For sure, all of those coins are ultimately ruled by their coding and their nature, as a store of value is fundamentally different from a privacy coins. And we also talked in this video about NFTs, as they were a proof of ownership, a ownership of art to financial NFTs. So I hope you guys really like this video. Until next time, take care of yourself and enjoy.